Investment income is chapter 10. What is investment income? This is dealing with individuals who are receiving bank and building society interest. Now, a building society, by the way, is a particularly English colloquialism. It's basically another form of bank. Same thing. In the UK, it's received net of 20% tax by an individual. The reason why the tax is taken off at source is because not everyone in the UK fills in the tax return, so therefore the bank is a collector of taxes on behalf of HMRC, i.e. Her Majesty's Revenue and Customs. Now, when you come to do an exam, you must be careful what the question is saying. Is the questioner saying they have received interest of 800, or have they said the individual has gross interest of 1,000? You've got to watch for the difference, because in your computation for income tax you must put things in gross. Now clearly the tax withheld by the bank is 200. That can be used to offset your tax payable that after you've calculated your tax liability. Tax liability is your total tax due. Okay, so in the exam, watch for that. Is the examiner talking about receiving bank interest, and by definition you receive the money after tax is taken off, or is the questioner talking about the gross interest of X, in this case 1,000? Don't gross up 1,000 become 1,200 or something. Okay, rate of tax on savings income. Normally taxed the same as other income, in other words it gets added to your income. However, there is a starting rate of 10% to the first 2,560. We did talk about that in one of the earlier chapters when we talked about a purse allowance. Remember the purse allowance was 7,475. So if that was your salary, to which you then had 2,560 of savings, that wouldn't be taxed at 20%, it would be taxed at 10%. Okay. Once you get above that, say your total earnings are, taxable income is 20,000, and then you had savings above that, then it would be taxed at 20%. Okay. Dividend income, that's the other big favourite of the examiner. Dividends are received net, so will need to be grossed up. Dividends are deemed to be received net of a notional credit of 10%. So unlike savings where it was 100 over 80, for dividends it's 100 over 90. So just watch for that in exam questions. And your tax credit of 10% can be set against the individual's tax payable. Okay. Now we've got this horrible little percentages, rates of tax. Dividends are treated as being the top part of an individual's income, and they go on top of other income and savings income. So dividends are then taxed as follows: 10% if you're in the basic rate band, which is the first 35. Dividend income in the higher rate band, which is 35,000 to 150, is 32.5, and above that 42.5. Don't forget, income tax rates are 20, 40 and 50, which is why we have these funny little quirky rates when you tax dividends, if you receive these. Okay, so that's the one big quirk of this little section. When you come to the practice phase, you'll see some of these questions laid out for you. Okay, that's the end of that chapter. So chapter 11 is pensions, another short, sweet chapter. What are pensions? Well, it's an efficient tax saving retirement scheme. You put money aside and you get tax relief going in. Clearly when you earn the money as a pensioner, you get taxed as it gets paid out. two main types of pension schemes you need to learn about: occupational pension schemes, which is for certain employees, and a personal pension scheme, which can be for employees, sole traders and the unemployed. Individuals can make contributions to a pension scheme of any amount, but will only be eligible for tax relief on contributions as follows. The higher of £3,600 and 100% of the individual's relevant earnings. Now, what's relevant earnings? Well, it includes trading profits and employment income. So, pretty much everything that you'd want it to include. Now, method of obtaining relief. Occupational pension schemes, you would obtain tax relief at source. So when you pay the money, you get 20% tax relief. The pension payment made by the employer is deducted from the employment income, and the employer calculates PAYE on the net amount. If an employer also makes contributions to the employee's occupational scheme, those deductions are tax deductible in calculating the employer's trading income. The contributions will not be treated as a benefit on the employee. Okay, so the occupation, so the employee pays the pension and gets tax relief at source. They get full relief, whether it's 20, 40, 50%. Now, personal pension scheme, however, is slightly different. It's given automatically as net of basic rate of income tax. So the individual pays into the scheme and they get 20% at that point. Now, if you're a higher rate taxpayer, relief is given by extending the basic rate band. So if you pay a contribution of 8,000 net, the contribution is grossed up by 100 over 80 to obtain a gross contribution of 10,000. Your basic rate band, therefore, a taxable band, is extended by this 10,000 in this example to create a 45,000. If you're a higher additional rate threshold taxpayer, then the 150 becomes 160. And then you calculate the tax computations. You remember the tax computations we had in the very, very beginning? That's what you're doing here. You're extending the bands at which the higher tax rates will start. It will start later. Chapter 12, National Insurance. Just run through this again fairly quickly. National insurance is a social security contribution paid into the state by both employers, which is called secondary, and employees, which is called primary. But having said that, an employer also has a Class 1A, which is a social security benefit on benefit in kinds. The self-employed, the sole traders, they pay a Class 2, and they also pay a Class 4. Class 1 primary and secondary is calculated as a percentage on gross earnings, and it's usually over 7,225. So it's not quite the personal allowance. Remember, the personal allowance was 7,475. So there's a few little quirks here. At Class 1 employee is 7,225. It's nil. Above that, it's 12. And above 42, it becomes an extra 2% on the balance. Class 1 is 7072. Notice before it was 7225, so it's a lower number again. I guess employers, companies don't have votes. Above 7,072, it's 13.8%. And yeah, as I say, 1A is on most taxable benefits provided by an employee. So if you have a company car, calculate the benefit, that's going to be taxed on the individual. The employer will have to pay some national insurance at 13.8% on that benefit in kind. NIC at the flat rate of 2.5 for self-employed, and Class 4 again you've got these profits, which are very similar to the employee contributions we had up here when you had employee working for a company. That's where they come from. NIC rates will be provided in exams. Okay, that's the end of that chapter. See you in the next one.